You might have read the book, Measure What Matters. It's written by a guy called John Doerr. He's a venture capitalist and investor who's been very active in Silicon Valley over many years. Now, we're at a time when there's tremendous change. There's a lot of disruption. We may have good products, but are they good companies, and how should we measure them? Now, I'm here in London, and it's pretty cold out here, so I'm just going to start going inside and we'll have a coffee and we'll start talking about coffee and cakes and what that's got to do with financial performance. So I'm here enjoying a really great coffee. And I could have had a cake, but you've probably been reading about this company called Patisserie Holdings that's been facing a lot of challenges following allegations of improper accounting. Needed to raise additional finance at very short notice, which was provided by a major shareholder. The shares were suspended and there are ongoing investigations. The outcome, of course, is uncertain. Now, as a financial analyst or investor, measuring the performance of a company is essential. It's particularly important at a time of rapid and disruptive change, and as we seem to be at the end of the positive phase of the current economic cycle. We all know that defaults and losses will increase in a downturn, and that there will be changes in credit spreads and company and asset valuations. We also know that even in a market downturn, some companies will succeed and exceed reasonable expectations. So what should we be considering in evaluating the financial performance of a company? First of all, we know that we can't rely just on the accounting numbers, as they can be manipulated. For high growth companies, in the growth phase, they are highly likely to consume cash. Tesla cars are beautiful. WeWorks has changed the perception of how people work and is developing the concept of real estate as a service, not as an investment asset. Uber and similar companies are transforming people's thinking about how to travel. However, no matter how strong the product or service is, it's essential that a company will need to produce positive cash flows within a period acceptable to investors. For disrupted companies, such as traditional utilities, their business models have been disrupted by renewable energy, and they have to adjust. Low margin, high operating and financial leverage companies such as Carillion are particularly at risk from operating risks, cost overruns on projects and other similar risks. So what's the message for financial analysts? Number one, beware of using only the financial statements as a way of assessing a company's financial performance. Number two, consider what the markets are saying about companies in the form of share, bond and credit derivative prices where data is available. But be aware that there could be severe price changes in quoted securities when some news reaches the market. For example, the collapse of Carillion's share price in 2018 is a case in point. Thirdly, watch the economic and political environment carefully. Four, consider the operating and financial risks in a company very carefully. For example, the impact of the California wildfires on PG&E and the collapse of its share price after October 2008. Change creates risks and opportunities both in the growth and downturn phases of economic cycles. With rapid changes we're experiencing, I consider it likely there will be more uncertainty, more volatility, as well as potentially higher losses or gains for failing or successful businesses. If you want to think about how this impacts on the skills needed by financial analysts, please take a look at the digital training I'm providing on essential qualitative and financial analysis at a time of rapid and disruptive changes. You can download a free introductory model on https:/m-training.thinkific.com/collections. And of course, I'll be very pleased to speak to you about the training program.